Every year, Spiva publishes data on how actively managed funds perform relative to their benchmark index. The 2024 results are in, and if you have money in an actively managed fund, you need to see this data. But here's the more interesting question. How do AI-driven investment strategies compare to both active human management and passive index funds? The answer might completely change how you think about investing. Let me be upfront about what we're comparing here. On one side, actively managed funds run by human portfolio managers. On the other, passive index funds. And as a third category, AI-assisted and algorithm-driven investment strategies. We're going to look at performance data, survivorship bias, fee structures, and what the evidence actually suggests about where AI fits in this landscape. The 2024 Spiva data continues a decades-long trend that should be alarming to anyone paying for active management. Over a 10-year horizon, approximately 88% of large-cap active funds in the United States underperformed the S&P 500 index. In Europe, the figures are similarly discouraging. And importantly, this data accounts for survivorship bias. Funds that shut down due to poor performance are included in the calculation, not quietly removed. Why do human managers underperform? Several reasons compound each other. First, fees. Even a 1% annual management fee is a massive structural drag over a decade. A fund returning 10% gross becomes a 9% net return, which compounded over 10 years is a difference of over £40,000 on a £100,000 initial investment. Second, trading costs within the fund erode returns further. Third, behavioral biases that affect retail investors also affect professional managers. Career risk makes fund managers herd toward consensus positions rather than making the genuinely contrarian bets that outperformance requires. This is where it gets genuinely interesting and genuinely complicated. There is no single clean dataset for AI investment performance comparable to Spiva's active fund tracking. What we have instead is performance data from quantitative hedge funds using machine learning models, back-tested results from retail AI platforms, and academic research on algorithmic trading strategies. Quantitative hedge funds using AI, firms like 2 Sigma, Renaissance Technologies, and D.E. Shaw, have consistently outperformed traditional active funds over long time horizons. Renaissance Technologies' Medallion Fund, arguably the most successful investment vehicle in history, has generated returns that are simply not explicable without algorithmic pattern recognition that no human team could replicate. However, these funds are closed to ordinary investors, charge enormous fees, and operate on strategies that cannot be replicated with retail tools. For retail-accessible AI tools, the evidence is more mixed. Back-tested performance of algorithm-driven strategies consistently looks excellent. Live performance is more variable. The honest picture is AI-assisted strategies that focus on removing emotional decision-making and enforcing systematic rebalancing have a documented edge over emotionally driven retail investing. AI strategies that claim to predict market movements or identify mispriced securities better than the market have a much spottier track record. Here's what the evidence actually supports. Passive index investing, buying a low-cost S&P 500 or global index fund and holding it, beats most human active managers over long periods. That is essentially proven at this point. AI-assisted investing, done correctly, can add value over passive indexing specifically by improving the research process to identify high-quality individual stocks, automating rebalancing to remove emotional timing errors, and enabling systematic factor exposure that outperforms cap-weighted indices over long periods. What AI cannot reliably do: predict the market, time entries and exits with consistent precision, or identify information that genuinely isn't in publicly available data. Markets are too efficient for that, and any edge that AI discovers in public data tends to get arbitraged away quickly once it becomes known. The durable edge from AI is in process, not prediction. The data is clear. If you're paying high fees for active human management and getting index-level or below-index returns, you're being taken advantage of. AI tools give you a better alternative. I've put together a comparison table of active fund fees versus AI-assisted platform costs in the description. Download it and check whether your current investment setup is working for you. Subscribe for more evidence-based content.